This is BTV. Profiling innovative companies on national TV and financial portals. With host, Taylor Tone.
Hello, I'm Taylor Tone, and welcome to BTV Business Television. Well, what do a greener source of energy for our cars, a cheaper way to fly, a better way to manage invoicing, and a Colombian gold mine all have in common? They're a very diverse group of small-cap companies, and according to senior investment advisor Brent Todd, that's a good thing.
Some of these small caps, there can be risk and they can be illiquid, so by diversifying, that takes some of that away. Do realize that the rewards can be great in this sector. These companies are at the steep end of the growth curve, so if the companies get it right, quite often the returns can be dramatic.
For some companies, the way it's always been done just isn't good enough. The conventional method of pumping underground brine deposits to the surface and extracting high levels of lithium they contain has a rather large environmental footprint. That's why this CEO was not only eager to talk about what his company is planning to do, but he also insisted on showing us what they're planning not to do. And that's why he took us on a little hike in the Nevada desert, uphill.
Here we are overlooking the Silver Peak lithium mine. This is the only lithium producer in North America, and you can see the extent of the evaporation ponds here covering 4,000 to 6,000 acres. This is not what we propose to do at Pure Energy Minerals.
The company's Clayton Valley Lithium Brine Project is midway between Las Vegas and Reno, Nevada. Thanks to the neighboring lithium mine, road and electrical infrastructure is already in place. So what does the new kid on the block have in mind?
We're going to adopt a new technology developed by Tenova Advanced Technologies, where we extract the lithium directly from the brine, and then we put that brine back in the ground where it belongs after having been cleaned up and removed of any contaminants. In doing this, we can produce lithium faster, better, and greener than it's ever been done before.
The game-changing benefits of the processing plant Pure Energy plans to build with Tenova and its technology partners, including Seuss Water Technologies, are all pretty clear to mining analyst Ryan Walker.
You pump the brine into your plant once it's built and you're producing in a matter of hours, versus the evaporation ponds, the traditional method, where you pump the brine into these pools and wait for Mother Nature to evaporate, and that can take anywhere from 12 to 18 months to start up.
Of course, innovative technology is only part of the story. Experience still counts.
I've been in the mining industry almost 29 years now, and I've worked across a range of commodities. But since 2009, I've spent a lot of my time in the lithium business. We've made discoveries in Quebec and Argentina, and now here in Clayton Valley, Nevada. We have a deep pool of experience in our management team. We understand project finance, we understand marketing, and we're a very technical group of people.
In mid-2017, the company announced their first preliminary economic assessment of the Clayton Valley Lithium Project.
This is quite a milestone for us because there have only been 4 previous PEAs on lithium brine projects around the world. The project envisions a 20-year mine life. After an initial capital investment of up to $300 million, it would be a low-cost producer of lithium hydroxide for about $3,200 a ton. The payback period would be easily less than 4.5 years, and it would yield an internal rate of return of 21%.
Proving it's all going to work starts by building a pilot plant.
That will give us the data we need to complete the engineering and design of a commercial plant. And that will lead, of course, to a feasibility study in about 2 years' time. From there, moving through project finance and permitting, this project could be producing its first commercial lithium by 2021.
But the company hasn't put all its eggs in one basket. They're also developing a lithium brine project in South America.
So this is right in the middle of the growing lithium industry of northern Argentina, and it's one of the most favorable places in the world for mining investment, the Salta province.
Producing lithium is one thing. Making sure you have customers is at least equally important.
Almost 2 years ago now, we signed a conditional supply agreement with Tesla. Here we are in central Nevada, only a 3-hour drive from the Gigafactory. We build a mine, they'll be one of our first customers. The lithium business is fast moving. It's booming like few commodities that guys like me who've been in this business a long time can remember. It's an exciting time.
The worldwide demand for lithium has doubled over the last 7 or 8 years. However, over the next 10 years, the lithium battery business is not expected to double. It's expected to quadruple. Coming up next, a supply chain solution targets a wider market. And later, from the CEO of a new airline, a challenging question.
Canadians, why are you paying so much for airfare? You don't have to.
This is BTV.
Welcome back to BTV. Cortex Business Solutions does one thing, and it does it very well: e-invoicing. Over the years, this Calgary, Alberta-based company has built a loyal and satisfied customer base in the oil and gas sector. And yet, profitability has eluded them. But with the new CEO at the helm for the past 2 years, the company has steadily been making fiscal progress.
When I walked in the door 2.5 years ago, we were bleeding about $7 million a year in investor money. We had never capitalized on a critical mass moment. We had burned through all that money, and the day I walked in the door, I think we had about 120 days of capital left.
But Litzo knew the company was selling a very effective e-invoicing solution. The Cortex Trading Partner Network instantly processes paperless invoice data that a buyer receives. What makes the process so appealing to suppliers is pretty obvious.
Literally from the moment of submission of a supplier, within seconds they're getting a response from their buyer saying, I've approved your invoice for payment and the net terms start today. We're putting it into the buyer system, doing a 3-way match that says, is this what I was supposed to buy? Is it the right price? And have I received it? And if those 3 questions are positive, we move it to a payment status.
Sounds simple, and it is for the users, but what's going on under the hood is a bit more complicated.
What's really uniquely different about Cortex is our ability to extract data from disparate sources. And what I mean by that is, let's say that on the supplier side, it's 2 guys in a truck, small business running QuickBooks as an accounting package. On the other side of the supply chain is the buyer, and that buyer might be a global multinational corporation, and they're invested in an SAP or an Oracle size system, and the 2 just simply don't communicate. So the supplier provides the data to us, we rearrange that data in a format that the buyer's expecting, we insert that data into their system, and we've reduced the human touch on the push, we've reduced or eliminated the human touch on the receive.
Cortex delivers its software through an open network as a service to over 10,000 suppliers and buyers. Greater efficiency is just the starting point of what this e-invoicing solution has to offer.
We facilitate the transfer of that invoice, and then the response is back for whether or not that invoice is going to be accepted or rejected or that type of thing.
In a lot of cases, I'll have clients say, Joel, I knew about that problem 60 days before I would have found out about it on paper, simply because I had access to it. And when I have access to information sooner, I can make better decisions in the business. And I think as you speak with some of our clients, they're going to resonate that exact concept of visibility equals power, and power to make changes.
We spoke to a Cortex customer, the Calgary Sports and Entertainment Corporation. From owning and operating the Calgary Flames, their enterprise has grown to include several other teams, the operation of the Saddle Dome, and a concert business. But growth has its challenges. Changes had to be made.
We were processing over 24,000 invoices a year, and we were doing it all manually. Our invoice approval process was greater than 30 days, and that was resulting in a strain with important vendor relationships, as well as we weren't able to realize discounts for early payments. And the implementation of the Cortex solution has moved that approval cycle to 7 days. And because of that, we're now able to realize early payment discounts.
With continued growth in sectors other than oil and gas and a new approach to sales, even with staff trimmed down by half, the company reached an important milestone in 2017.
Q3 was a monumental moment for Cortex. We're in the 10th year as a business, and we hit our first cash flow positive quarter from operations in the history of the company.
The company's turnaround has certainly impressed analysts like Pardeep Sangha.
Cortex's performance, stock performance has been phenomenal. This year so far, the company's stock price is up 25%. Year over year from last year, it's up about 70%, and we think it's a great opportunity for investors to be getting in at this price.
I'd like to grow this company north of 30% during my entire tenure. The more we grow the size of the network from 10,000 to say 100,000, the more exponential value there is for each of the members of the network.
Getting bigger isn't the only way Cortex is trying to get better. The company is constantly adding value to the Cortex Trading Partner Network with the regular release of technical enhancements and the addition of new strategic partnerships. After the break, a mining company in Colombia that deserves a little more attention.
It's one of the richest vein systems in the world.
And later,
Canadians want to fly, they just need to be able to afford to do it.
This is BTV.
Welcome back to BTV. Next up, here's what this mining analyst has to say about the gold sector.
A weakening US dollar and improving global demand sentiment bodes well for the commodities in general. In the case of gold, a layer of complexity comes on the back of geopolitical risk consideration, where rising tensions can actually fuel the gold price while being detrimental to other commodities such as base metals, copper, and zinc.
Gran Colombia Gold has become the largest underground producer of gold and silver in Colombia. It has several mines and 2 processing plants. The company has spent the past 4 years expanding and modernizing to significantly reduce the cost of production. Yet their executive co-chairman thinks his company deserves much more attention than it receives.
Gran Colombia was formed to take advantage of the resources that we knew existed when we were in Colombia in the 1990s, but it wasn't the right time to be there because of political unrest. We took advantage in the early stage of buying incredible assets at a very, very low price and be the first to develop in the area.
The first to develop a modern gold mine. The area was a source of gold in pre-colonial times and has been mined almost continuously since the Spanish took it over in 1527.
Marmato was the first area that we started developing. We did more than 400,000 meters of drilling. It was done in the 2007 time when gold in the 1600. Everybody was looking for monster projects. We actually found Marmato was a monster project. It's a project that's got 14 million ounces in resources. Plus we have on the lower part potential for another 6 to 8 million ounces of gold. We started developing that project, but then with the prices of gold collapsing, we set it aside.
With Marmato on hold, the company turned its attention to the Segovia mines after taking control of its assets in 2010.
Segovia was a much more mature mine. It was an operation that was in production. It was for us to reorganize it. We restructured it, we defined more resources, and started increasing production into the mine. The increasing of production, we took it from being a small producer now to a mid-sized producer.
In 2016, the Segovia operations produced over 126,000 ounces of gold at $655 US per ounce. But the company has only explored about 10% of its concessions.
Our goal is to not only develop the existing mine, increase the production, but also to go and more aggressively into exploration in other areas and develop. In Marmato, I think the next stage, we have pretty much defined what kind of deposit it is. Now we are doing a pre-feasibility on the underground potential. We are looking pretty much to develop something in the same size that we have in Segovia.
When it comes to the future of gold in the modern world, Serafino Iacono doesn't hesitate to offer an opinion.
In the world that we live of bitcoins and all strange currencies that I honestly don't understand because I'm a physical gold guy. To me, gold is just going to increase in value. It's going to be part of a portfolio of investors as a hedge against currency, as a hedge against catastrophes. I think we are in an up cycle that starts with the gold going up and then all the other metals coming up.
One thing that's definitely going up is production at Gran Colombia Gold. The company recently announced that they broke a monthly production record, and they've released a resource estimate for its Marmato project and a preliminary economic assessment for its Segovia project. Everyone wants to pay less to fly, and the folks at Canada Jetlines want Canadians to have that choice. Jetlines is confident their ultra-low-cost carrier will find the same success that other low-cost airlines around the world have achieved.
We as Canadians simply don't fly around our own country as much as we should compared to other people, and it's airfare. It's a lot cheaper for some people to take a vacation in Mexico than it is to visit their sister in Regina.
My question is, Canadians, why are you paying so much for airfare? You don't have to.
Canada is the only developed country in the world that doesn't have an ultra-low-cost carrier. The model has been perfected in Europe, perfected in the US, and perfected in Asia.
The technological advances in the industry have been significant over the years. The input costs for airlines have dropped dramatically, including the price of fuel. Yet, the airfare structure here in Canada is relatively unchanged.
And why is that the case? I don't think you'll be surprised by the answer.
Because there's a lack of price competition.
There is a duopoly here in Canada.
92% of the domestic traffic is dominated by Air Canada and WestJet.
Canada is the 16th most expensive aviation market in the world.
We think there's room for a carrier to come in at a lower fare level, take market share and stimulate new demand.
So if fares are high because of a lack of competition, then what has really prevented an ultra-low-cost carrier from taking off?
The reason we don't have an ultra-low-cost carrier in Canada is really the lack of available risk capital to get one off the ground in the domestic financial markets here in Canada. For launching a new airline, you'll really need access to foreign money that has experience in investing in these type of ventures.
Though Mark Morabito already had a track record raising capital in the US, Asia, and Europe, he had to go to the Canadian government, not for a handout, but for a hand up.
I felt that if I was able to get access to that foreign money for a ULCC venture, that I could get it done. But that meant I first had to go to the government on bended knee and ask them to raise the foreign ownership limit for this project, which is something that they had never done before in the history of the country.
Raising sufficient foreign capital has been critical. Raising experienced human capital? Priceless.
People are clamoring for an alternative. We have over 90% of the market controlled by 2 incumbent carriers.
I love working with this team. These are some of the most experienced ultra-low-cost carrier executives in the world, and we absolutely have the A-list on our board.
We're following the EasyJet model. We have 2 former executives that helped build that company at the senior level. One has gone on to do so again at Wizz, and we're following that model.
With a combined 20 years of experience in senior management at EasyJet and Wizz Air, John Stevenson understands why those 2 airlines have succeeded.
EasyJet and Wizz Air have been successful for so many years because they identified the right business model at the very beginning and they kept a disciplined approach to delivering that business model.
When we come back, we'll find out how Jetlines plans to save Canadians money and become their favorite new airline.
This is BTV.
What are a few of the features that will make Jetlines a successful ultra-low-cost carrier?
First is significantly lower costs than the incumbent carriers, so you can offer significantly lower prices. The second thing is volume. It's about focusing on the many, not the privileged few. The third thing that characterizes ultra-low-cost carriers is operational simplicity. For example, you would have only one aircraft type in your fleet. The fourth item is a pay-per-use model, so that you don't penalize the customers who only want the seat. You just pay for what you use.
Jetlines expects to be in the air by June of 2018. And where do they plan to go?
In the summertime, we'll be flying domestic Canada and selected points in the United States. And then in the wintertime, we will shift a lot of our capacity to deep south flying to the sun destinations that Canadians want to go to. We're going to be centrally located in the major population center of Canada, which is Toronto. Over 8 million people reside here. All of our flights will originate and terminate in the Toronto area.
But don't look for this ultra-low-cost carrier at the ultra-high-cost Pearson International Airport.
Starting out, we're going to be flying from Hamilton Airport, and we won't touch Pearson with a 10-foot pole. You use the secondary airports and build up your customer base and build up your loyalty and develop a following. That's the key, one of the keys to success of an ultra-low-cost carrier.
Jetline's strategy of relying on secondary airports should have spin-off benefits.
Airfare is critical, as you think about business and you think about people headquartering their businesses in your community. We're really lowering the bar in terms of cost for people to access that air service. It allows us to go into markets that maybe previously couldn't support or didn't support direct and consistent jet air service.
They want to know, are you going to fly to? And it's the airport near them. And people are just clamoring for it.
And the presence of an ultra-low-cost carrier in Canada may provide another benefit.
The effect that Canada Jetlines will have on the Canadian aviation market will be to lower the fares overall for all customers. Not only will our customers benefit by getting an ultra-low fare, but I would expect that the fares of the mainline carriers will come down as well.
There will be much marketing fanfare, but the actual startup will be quite modest.
We've got 2 aircraft to start. We have to start signing up leases for more aircraft. We need agreements with more airports, and we need to put the financing package together that'll allow us to launch and withstand some competitive response. All of that work is underway, and we'll proceed in an orderly fashion as we move to launch date next summer.
You can have sufficient capital, the right strategy, and lots of experience, but ultimately, you still need to believe you're going to succeed.
Has the right business model for this market.
We are going to be able to offer customers the lowest fare in the marketplace.
Canadians want to fly, they just need to be able to afford to do it.
On the first flight, I intend to be walking the aisles with the flight attendants serving the customers.
Will Canadian travelers be lining up to fly the ultra-low-cost skies? Jetlines should find out when seats go on sale next spring.
Our investment in Canada tends to be a lot more smaller companies, companies that are under 100 million market cap, companies that are coming up with innovative technology, and that's where a lot of the focus is, to be high growth, but also potentially higher risk as well.
Thanks for joining us today. Well, you've heard the expression, no risk, no reward. That pretty much sums up small cap investing. But if you're game, the opportunities are definitely out there. For BTV, I'm Taylor Tone. Until next time, may your portfolio prosper.